Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. December corn posted a significant low on August 31st, and from there the market advanced up into our timeline of September 5th. From that point, the market has been declining, and we're currently now sitting on our next potential time horizon of September 20th. From here, we can see the market move down into that timeline, and we're looking at a potential reversal. The key for the December contract right now is support that we have sitting at 348, and we believe that this Fibonacci retracement level is a key make or break level. At this juncture, we're looking to see whether or not this market posts a close below 348 or 353. Whichever it does first, we believe that the market looks to find continuation in that direction. In all likelihood, we're anticipating that the market will perhaps make a move downward to retest the 344 low, where we have a potential target sitting at 342.5. If and when the market makes a low near this area, we think this is a potential buy opportunity, with the caveat that the market could move down as low as 335 to 337. If we are able to advance from current levels and break over that 353 number, we anticipate a minimum price objective that sits somewhere in the neighborhood of 365 is a good area to take some profits off the table in the event of a nice run. That 365 number also happens to coincide with one standard deviation below the point of control, so we feel very good about that target range in the event that this market again is able to close above 353 prior to closing below 348. That potential target range that we discussed happens to coincide with the 270-degree mark, and in the event that the market continues to find legs beyond that number, we would anticipate a potential run up to 373 is also possible. With only 2 days left in the week right now, we're simply waiting to see whether or not this market crosses over that 353 or 348 number first. November beans has run up against our resistance band of 979 to 984. And as you can see, the market has tested this area several times and continues to find difficulty trying to get through that number. Right now, that magic number for this market seems to be the 979.25. And once this market's able to close above this label, it can potentially find some legs. For now, we continue to anticipate that resistance in this area of 979 to 984 would hold. And if and when this market fails at this area, we would be looking for the market to retest previous lows with the potential of reaching down to about 900. Not only did resistance at 979.25 hold up very well for this contract, we also found that support at the standard deviation level of 962 held up very well. So from here, we anticipate that between 963 and 979.25 over the next couple of days could very well be the trading range for this contract. And once this market again is able to break through either side, we anticipate continuation in that direction. We're looking for continued movement to the downside for soybean. And as we can see, for now, the 963 number will be the key operating number that we would be watching. Resistance overhead also happens to live at the 180-degree mark of 983.25. And that also happens to coincide with the top end of that Fibonacci band that we spoke of just a moment ago. The last time the market reached the 360-degree mark down at 921.5, the market held up very well and bounced from there. We do anticipate that the next time the market makes its run down to this area, it could very well go through, and we'd be looking at a downside target, as mentioned before, in the neighborhood of 890 to 900. Wheat futures has walked up into our time factor of September 20th, and as we can see here, the market has been gradually making its way up into this time horizon. What we would be looking for in particular is to see the way in which the market responds off of resistance. Right now we have resistance sitting at 453. And then beyond 453, we have the next key level coming in that actually traces along our arc right here. So if the market either finds very good resistance here at 453 or is even able to make its way up to touch our circular arc here, The next key reversal that we see now that we've reached our time factor date with the seller's bar would be a reasonable selling opportunity. Upon moving down, we'd be looking for the market to retest previous lows that were near 424 with a target objective somewhere in the neighborhood of 415 with the possibility of getting down to about 400. Our 453 resistance level is very close to the 455 quarter 180 degree mark. And as mentioned before, we're now sitting at in a very important time horizon where the market has moved up into that time factor. Our next seller's bar, in the event that the market finds resistance up against one of our key levels here, would again be an indication for a potential sell opportunity. We have a 360-degree mark down at 413.5, and that again does also coincide with the price objective that we mentioned on the previous chart. Lastly, you'll also notice that the tangent at the bottom of this circular arc that we had measured from some time ago gives us a target objective of 412.75, and we very much like this price target in the event that the market starts to make its way down. Crude oil futures continues to make quite the impressive run, and the talking heads right now are starting to concede that crude oil could very well continue upward. We do have a one-to-one correspondence from the previous swing that we had looked at before, and the market now has made its next leg up from that correspondence, touching 1.272% of that move. That $51 mark that we've long been sharing about has been suggesting to us that the market has the capacity to touch upwards of 52.80 and even get up to 54.75 once it's able to get a clean break of this 51 number. The market tested over the course of the last 5 days several times at this number and had not been able to close above. Right now, it's currently trading just slightly above that number, and if by day's end we're finally able to close above this area here, we would not be surprised to start seeing the market make a run up to 52.80 at a minimum. We like very much the way in which this market is moving. Additionally, we can see that the market, after having made a very nice run, gave us a pullback right up into that 50% area, holding that zone, and now we're looking at the next leg up. So given the way in which this market is moving and the fact that it is also testing the 180-degree mark, which also happens to coincide with our $51 mark, once it's able to get through this number, we think the market has a reasonable chance of reaching higher. Here we have a look at the December cotton contract. And after having spiked in volatility quite a bit, both in the up and down direction, the market right now finds itself in a small consolidation pattern where the market found very good resistance up against one of our quartile levels. And from here, we anticipate that cotton could very well head back down again. It found very good support over the last week up against another quartile level, and from here the market has bounced. But as you can see, over the last 5 to 7 trading days, the market has barely covered about 20% of the previous range that was covered in the course of 2 days. This tells us that the market potentially has more sellers behind it and could very well make another leg down. Right now, we're looking at a potential price objective of 66.40 if and when this market breaks back down again. For now, we'd be looking at the point of control number of 68.90 as a very important level for this contract. If and when it gets back down to this number and closes below, we would anticipate continued weakness to the downside. The US dollar made one big spike low up against our support number at $91. That $91 mark was one factor below our key 360-degree mark. From there, the market has really been consolidating inside of volatility-based support between 91.5 and 92 and change. The market started off slowly today, but has since reversed very well and is trading at the top of its trading range right now. The market has overcome its earlier losses and right now is up almost $1 on the day. From here, if the market's able to consistently post a couple closes above the $92 area, we anticipate that the significant low that we've been talking about for the dollar could very well be in play, and we're looking at a potential upside target that could reach somewhere in the neighborhood of 93.5. From here, the market would probably find very good resistance between 93.5 and 94, close to the 180-degree mark. And beyond 93.90, we think the market has a reasonable chance of reaching up to a minimum of $95. Right now, the US dollar is sitting in a critical zone. We'll continue to watch the way in which it moves from here. But for now, the first key level that we're looking at is to see if the market's able to finish the week strong above the $92 mark. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.